So let's talk about it, right? Dr. Princell here, financial planner, estate planner. Let's talk about this. Authorized user account as an intergenerational asset. Okay. Firstly, the person who creates the authorized user account must be financially responsible. You don't want to just get an authorized user account for a young child or an adolescent who's doesn't know much about finance to begin with and is inheriting their knowledge of finance from whoever is guiding them, guarding them, taking care of them. All right. Some of us are also maybe younger than the people who we are caring for, that we have to extend our younger credit history to, because no one taught them about finance as well. So authorized user accounts require a responsible financial individual. They need to have what's called a level of fiduciary care, meaning they've got to operate within the best interests of the person that they're extending the credit to. Okay. Now, what's the authorized user account going to do? It's going to pass on the payment history of that individual to the new authorized user. Benefits of doing this means that the individual authorizing the additional party can control and also limit the access to what that person can do with it. You can authorize someone onto your credit score or onto your credit history, and they maybe issue a credit card, but you can hold on to the credit card. Therefore, you can be the one to make use of the proper uses of the total credit utilization. Now, we've talked about this also. Most people are not operating within the 30% threshold of your total credit utilization. So we have to talk about the importance of 30%, because anything above 30% is going to negatively impact the Fair Isaacs Corporation number, the FICO score, okay, which has a much bigger, plays a much bigger part in a person's credit worthiness, because that's actually where the credit history or payment history is, their credit worthiness, the likelihood of them also repaying their debts. There's a lot that that Fair Isaacs, the FICO people are tracking. Okay. Now, if if the individual makes a bad payment or defaults, that's going to negatively impact the authorized person's credit history as well. So this may be one of the reasons why you maintain control over that card. You might just authorize it, get it, cut it up, right? But just bear in mind, you have to use a certain amount of that card on an annual basis. Okay. And we'll talk very briefly about why 30% and whether or not you should be, using that card for monthly versus annual services. So let's talk about annual versus monthly services first. Okay. Why would anybody want to get an annual service versus a monthly service? What happens on a month-to-month basis when you pay for something? Is what actually comes with a month-to-month payment?
Interest.
Interest?
Interest, interest, interest. Yes, indeed. The eyes have it. Interest, right? So let's talk about interest. The interest for monthly services is higher than it is for an annual service, right? So because there are also service fees that come along with that, like, servicing fees, rather, you have to think about that as well. Okay. So whatever the 30% threshold for the total credit utilization is, you don't want to go beyond that. If you got one card, it's got $1,000 on it, 30% of 1,000, just real easy math, $300, 30%. Don't use anything more than 30%. Some of you guys want to create businesses. This is where I'm going to go kind of fast. All right. Some of you guys already got that look on your face like, okay, I'm ready, because I know he's about to go really, really fast. You got $300. $300, you're going to use that for creating a website. because if a website makes your business real in today's day and age, you could even get by without having to use a website, but using digital business cards as an alternative to an actual website, maybe it helps save you some overhead, but it may not visually be appealing to the people that you want to serve. You might want to list more of your services. So we're looking at a website. You're looking at web hosting and domain name. So you got to think about those two things. Don't just think, okay, I'm just going to spend money. No, you got to plan. All right. And this is the reason why you want to be maybe thinking about holding your business in a trust or operating an unincorporated business as a trust first for about 3 to 5 years, because, well, what happens to most businesses in the first 3 to 5 years?
You fail.
Fail. Anybody want to create a plan for failing?
Nope.
Absolutely not. Absolutely not. So, and that's oftentimes where the failure comes in. It's not the plan that fails, it's the failure to actually plan that fails. So, you guys plan this out. You got your business website. The website costs $150 for the year. Everyone catch that? It's $150 for the year, right? It's actually $149.99. You guys play with pennies, and it'll make sense why they do that too. Okay. Now, they if you look at the monthly price, it's $14.99. Come on. Come on. It's $14.99 a month. Anyone seen the difference in that math there? $14.99, you multiply that by 12 months, it's more than $150, guys. It's more than $150. Okay. So what are we talking about? Staying within the budget. All right. You might pay for the lump sum service of $150, you saved some money. Now you got to think about your minimum payments on the 30% that you use. Now for interest rates, some of you guys are going to get introduced to credit cards, especially when you're brand new to it. You're getting notices and offers for credit in the mail. And a lot of you guys are so excited about signing up, but every time you sign up, your credit score suffers a little bit of a hit. Why? Because nobody's telling you that every time you do a credit inquiry, whether soft or hard, it hurts your credit score. It drops it. So some of you guys might start out in the morning with a 700 plus credit score, but you ran 4 credit applications for the day. Now you're looking at the end of the day, your credit score is at 5 something.
What? What then?
What happened there? No one told you? No one tell you guys? If they didn't, I hope that you're taking some notes now and saying, okay, well, how do I prevent that from happening? Some of you guys are already the victims of identity theft and identity fraud. You've got to remove that possibility from being a part of the case too. So when you're doing your estate planning, here's something for you to think about, because I mentioned this before. Here's something that I mentioned before, is this. Your trust can come with its own EIN number.
Okay.
So because it's got its own EIN number,
You can't have one of those. Where's the big soda?
because it comes with its own EIN number, what you can do is you can open up a bank account with that EIN number. All right. You can apply for credit with that EIN number. And I had a question in the chat. Can you block them from usage with the credit company? Yeah, you could. For example, what if they call the credit issuing company as an authorized user with their social security number and ask to be issued a new card? That's a possibility. You're absolutely right. But here it is that you have to be the authorized, you have to take, in the instance for like a child, you have parental control, right? In the case of like a sibling, a niece, a nephew, a parent, something else of that sort, you still are the one that's authorizing them. So all the important decisions have to go through you. The only thing that they could essentially do is overswipe. So when you give them the address of where that card should be sent, be mindful about where you want that card sent. With great power comes great responsibility, and you might be giving it to someone who hasn't learned how to be responsible yet. So excellent question. Definitely be mindful about where you send the authorized user's card to. Okay, and I think that that'll help save you a lot of frustration and headaches in advance. Okay, what's going on, Dr. Michael? Over there getting this information at a young age. I like it. Love it when we got the youngsters on here. I know we got some other kids on this, some other children on this call that are listening in as well. So, you know, of course, this is always for the next generation. You know, and this is what this should be about. Okay. So, and we're gonna there's a question about taxes. We're gonna come back to taxes in a second, because we gotta always think about first liability. All right, the first expense in many people's line of items. All right, is the taxes. Right. Fortunately, real quickly, trust is exempt from taxes. Right. So like any taxes that are made or paid by the trust are completely and totally voluntary, which I like to encourage. All right. I like to encourage the filing of a voluntary filing, because the more you tell these people, the less they come messing with you. All right. But now bear in mind that the IRS also has stated that the taxpayer has complete rights to enjoy the lowest taxable liability possible. You just got to be intelligent about what the government is incentivizing you to do, so you can take advantage of some of those things. Help with student loans. Okay, we can definitely talk about some student loans as well. Those are some very tricky debts to handle. All right, but there are solutions. All right, now here we go. Let's go back to the interest rate before I get too far off the interest rate conversation. All right. So we're using 30%. We got $300. We spent $150. The minimum fees for a brand new credit card, like what you might get from Capital One, they offer you 0% interest. We've all seen that Samuel L. Jackson commercial, right? Samuel L. Jackson's like, oh, the Capital One's premium silver card, right? You know, for the first 12 months, you're going to pay zero. And everything after that, you know, we're gonna give you some cash back. So you think the cash back part of it sounds really cool? They got this handsome, debonair, dark-skinned gentleman, because that's how they get us, right? It's always the tall, dark, and handsome guys. Think about State Farm. Think about, you know, the State Farm guy for a long time, and then they replaced him with Steve. And Steve is the handsome, dark-skinned dude with the, you know, guys on the phone with them in the middle of the night. What are they marketing to people these days? You know what I'm saying? What are they really trying to sell you? In any case, you know, Samuel was over there talking about a 0% for the first 12 months. They don't tell you what happens after month 12, day one. Month 12, day one, they give you a new interest rate starting at 12%, 16%, 20+%. Now, to how many people do these interest rates sound really good to? By show of hands. By show of hands. I'm not seeing any hands. I don't see any emojis. I don't see anyone. I don't even see smiles right now. Okay, I probably just asked the wrong question. I apologize. You know, I gotta check the pulse. All right. From 0 to 12%. For those of you who don't know or are not familiar with the rule of 72, the rule of 72 is the banker's rule. We use that to approximate how long it takes an investment or a debt double based on the interest rate. So let's start at 12%, right? 72 divided by 12 equals anybody? And don't be afraid to get a calculator, you know, get some extra hands and feet out there, you know, maybe this your cat or dog. I see 6 in the chat. 6 in the chat is correct. 6, I heard also some 6s. So 6. Now that means that at a 12% interest rate, it's going to take that debt to double 6 years from day one, right? Day one, and 6 years after day one, if you're still only making a minimum payment, that debt is going to double. So if you had $1,000 or $300 in there, in 6 years, that debt is going to turn to $600. All right. Now, let's go to this interest rate. Interest rate, you would need to divide by 365 days, right? And the interest rate will tell you the daily interest. These credit card companies don't tell you this, but I'm telling you this. They count up the number of days in the month and they charge you that as the interest rate on top of your minimum principal payment. All right, guys? So here's where a lot of us get lost in the sauce. You're paying way more into the interest and you're barely touching the principal, which means the principal part of the debt stays around much longer, okay? Which means people stay in debt and end up paying 2 times, 3 times, and even 10 times more than the initial debt was. Something that started out as a simple basic payment has now become something that they're paying off until they're 85, 90 years old, 100. And that's not what people should be doing, right? So think about that before you spend the money on the next credit card or on these zero interest credit cards. Be mindful if you're using more than that 30% threshold and you can't afford to pay that off in the first year, especially if you got a brand spanking new credit card, while there's no interest on that credit card, can't pay it off in a year, don't make the investment. Don't, okay? It's going to hurt you. It's going to become something that becomes a financial burden to you. It becoming a burden to you will make you a burden to someone else, all right? It's all interconnected, all right? So let's keep going. How do you find out your daily interest rate? Again, to find out your daily interest rate, divide the interest rate that your creditor has told you by 365 days, right? And that'll tell you what the daily interest rate is, okay? And then that'll be added. You want to think about how much that is on a monthly basis over the lifetime of your debt. We got a hand that's raised. I'm going to ask this person to unmute themselves. Sorry about that. I just muted you. Go ahead with your question.
Can you hear me?
Yes, ma'am.
Another thing I think a lot of people don't realize too, you can always roll it over to a credit card a new credit card that has 0 interest on it to extend your time.
That's right.
Definitely when you get a credit card and you put something on it, you basically figure out what you need to pay each month to pay that off within those 0 interest rates time frame. So
Absolutely.
let's start at that.
That's some good knowledge right there, because that's something that hasn't come up in our conversations before, is this approach and this strategy, which is one of the reasons why you want to be on these calls live, because you're able to ask some of these questions. We're able to put in some new tidbits, and every week that goes by, guys and gals, it's just gonna get better and better. Okay. So here it is that we've got a solution now. You got a credit card today in the mail, 0% interest. In 6 months after you've consistently paid off that history, you could do a couple of things, right? Number one, you can ask for an increase in your credit, right? That way, the cost of the monthly premium or the monthly debt gets lower. Number one. Number two, you can enjoy not just enjoy just a lower payment, but you could also stretch that out, okay? But now we don't want to stretch it out. We want to pass it on. We want to pass the debt along, right? So then here it is that after 6 months, with good credit history, now it's a good time for you to go and apply for another line of credit, right? If you're applying for, like I gave the example of, someone made the poor decision of applying for 4 different credit cards in one day, started at 7+, at the end of the day, they're at 5 something, maybe below that. This is a way to avoid that altogether, okay? You may, for each approved line of credit, you do one per 6 to 12 months, all right? So now you got the month 6, you ask for a credit increase, they increase the credit, you wait a couple of more months, you don't apply for credit yet, you're approaching month number 8, month number 10, apply for credit. Now you're getting closer to that 12-month period. All right. You've got better history. What are you going to do? Once that card comes in, now what's the new 30% threshold? Number one, it's going to be lower than what it was before because you paid off that debt. We're under the 30% threshold. We're not going over, we're not putting ourselves in hardship. All right. Nobody here is going to be able to put themselves in hardship if you're strategizing properly. Okay. So you got that card, month 12 comes, bomb. Swipe it, roll over the new payment to the new card, new 0% interest. The old card paid off. History looks good. It looks immaculate. Mama mia. Hey Bella. Hey Bella, right? There's 6 question in the chat. I'm gonna answer this question in chat, and then we're gonna go to the next hand raise. Is 6 months a good time to wait before applying for another credit card? Absolutely. But you know, again, 6 months is good, but instead of applying, increase the credit limit. Do that first, right? Then let it stretch out, enjoy some more good credit payment history, and then apply for that new card. In a matter of 2 years, you could have 3 new cards, 3 new lines of credit, and everything looking good. All right. So 30% all around. Hey, we're doing some great things here. All right. Thank you for adding that in. All right. So let's go to the next question. Next hand that's raised, I'm gonna ask the person to unmute themselves. When you're ready, please go ahead.
Hey, just excellent on the credit stacking as we were still talking about. Second of all, second of all, what is the process of funding or building the estate plan on the trust?
Okay, excellent question. How do we go about funding a trust? All right. So excellent question. Doesn't get asked very often, but it should be. Okay. Easy answer. You got a 9-digit EIN number, go to the bank. When you open up a bank, they're going to ask you to fund the account. They're going to ask you to fund the account with the minimum. And for some banks, for the majority of the banks, they're $100, right? So you have to maintain $100 minimum balance in that account, in the bank account, in order to maintain that trust bank account. Very easy to fund it that way. Other ways to fund the trust, you could title property or assets in the name of the trust, right? That's another way to fund it. Let's say that you got cash on hand, you're going to actually purchase an asset, meaning you don't have to worry about any payments after you make that one-time payment. It's yours outright, no monthly payments, which means a monthly liability because it's a monthly expense, right? So you've got the money in your hand, you're going to pay cash money. Well, when you go to pay cash money, they're going to ask for the name of the owner. The name of the owner should be your living revocable trust. For those who are establishing their living revocable trust, exactly how it's spelled, all capital letters. All right. And just like that, once the title, the deed for property, the wet ink dries, that is another way to have easily funded the trust. Other things you could do is you could do, for property that's being gifted to you or money that's being gifted to you, you could easily just put it right into the trust as well. Just put the name of the trust on it. Don't put the individual's name on it, put the trust's name on it. Okay. Very easy, no complications on how to fund it. Just like that. You just got to make sure that you put it in the proper name and spelling of the trust. If you change it, alter it in any way, it's two different entities or people or persons that you might be creating, all right? And oftentimes identity theft is created by the consumer themselves. So, you know, when if you put the wrong character in an address or a phone number or a 9-digit number, you know, that just became someone else. It just became another address. It just became a whole other state and entity or whatever. That's not good. No bueno there. Be careful about how you title your assets. All right. I saw someone. I hope that helped to answer your question.
And the same thing with the LLC.
And the same thing with the LLC, especially for the LLC. You're going to own a corporation. You're going to use the trust as a way to own the LLC. Then the LLC should be under the owner section should reflect the name of the trust, not the name of the individual. Okay. So, and while I'm on it, some of you guys are gonna make this one crucial error, which is putting your home address on your business or even on your trust. So let me introduce you guys to a concept called a registered agent. All right. Some of you guys need to write this down. A registered agent for most businesses is required. Most people will become or act as the registered agent for their own business, which is cool. However, you're still listing your own personal address. And as we talked about at the very beginning of this call, if the owner's address is listed on a document after they finish with the business, where are they going next if they haven't gotten everything that they wanted?
House.
You're showing up at your house. We got quite a few ladies on the call, right? Now, I don't know. Some of y'all might be okay with the handsome, dark-skinned gentleman like myself with locks showing up at your door in the middle of the night asking for some services, but some of you are married, and I'm pretty sure your husbands aren't going to want that either, right? They don't care how handsome he is. They don't care how good the locks look, all right? They're like, business is over at 5 p.m. Your office hours are 9 to 5. They don't want to hold anybody over a balcony, okay? Some of you guys know exactly what I'm talking about. You know, I see some of the men like, yeah, I will hold somebody over the balcony showing up in my wife business after 5 p.m. It's a problem, right? Somebody coming for them delicacies, it's going to be me, you know, the husband, not me, okay? And make sure I clarify that on the call. All right, so in case you don't want your personal address there, make sure you get a registered agent. Before you bother to incorporate registered agent services, they're fairly cheap. You can find one for under $50 a year. Get the registered agents service. They also come with an address that you can use for whatever purposes it is that you want of receiving mail. Registered agent's job is to be in receipt of all legal paperwork. Okay, so that way, if the business is served, the registered agent is informed, and the registered agent informs the business owner. So that way, the state has a clear line of communication with the corporations that register within their state. All right, it's just another way that they maintain territorial jurisdiction. Okay, now, just because you've got a registered agent doesn't mean that it's a registered agent in your state. I might be saying too much. I might be giving you guys too much strategy in this call tonight. All right. So some of you guys may not need to talk about having a foreign corporation in the state in which you do business because, I mean, you know, why would you need that unless you had a lot of assets and you were trying to prevent people from really come after you? So some states that maybe you want to know about, Nevada, Wyoming, South Dakota, Delaware. You guys might want to look into registered agent services in those states. You know, especially if you enjoy, you know, privacy. You were saying there, sir?
Yeah, but then you also check, those states also have the highest credit card interest rate too.
They certainly do. They certainly do. Got to read the fine print.
Why the big companies are housed over there.
And this is why, you know, if you follow the money will teach you a lot of lessons, right? It will take you to places that you never thought you would go. All right. And again, it's just in following the money. I want to introduce you guys to a concept, and then you know, I already talked about the tax benefits, which is that, like, the trust enjoys like a zero tax liability. So if your assets are held in trust and you formed a C corporation and then maybe applied for S corporation status and said, you know what, I'm just gonna just pass all the taxes to the level of the owner, the trust, which isn't required to file any taxes, but they do anyway because you know they're doing their business taxes right, and they've got a lot of expenses to run, right? And IRS only taxes you on profit, so things to consider. But one thing I maybe haven't breached yet that I want you all to consider is using the trust for non-asset related things, specifically as a designated beneficiary, right? So some of you guys and gals are married, right? Because you're married, let's say that you had something like a life insurance policy, right? The life insurance policy should have your spouse maybe as a primary designated beneficiary, and then your trust listed as a secondary beneficiary. That way, in the event that something happens to your spouse, the assets can still pass to your trust, which again will avoid or probate and certain taxes up to a certain limit, right? And with that, then it also continues to live out its existence the way that you
Mm-mm.
right. So let me see. Covered authorized user accounts. We covered avoiding court taxes. Avoidance is legal, by the way. Evasion is illegal. Let me just make sure I say that while this is being recorded. Okay. Evasion is illegal. Tax evasion is illegal, but tax avoidance is very, very legal. All right. You may need to talk to your tax advisor about what kind of tax exemptions are specific to you. And fortunately, hey, we got a tax advisor on the call. Actually, too, myself. Well, I'm no longer a tax advisor. I'm a tax consultant at this point. But we do have a tax advisor on the call. We're trying to make him a little bit busier. So, if you have tax related questions, I want you guys to definitely contact us. We're going to help you navigate this entire system. All right. But last thing I want to touch on in these last 5 minutes is something that our office does. Now, for this portion, I'm going to share my screen so that way you guys can see what we do differently in comparison to what quote unquote other financial planners say that they do. Okay, guys? So, can someone let me know if you can see my screen here?
Got it.
Thank you. So earlier today I had the opportunity to sit with a client, actually two clients who may be becoming partners. On a policy, we were doing a comparison. He's got two life insurance policies that are bundled, right? He's got a whole life policy for $1 million, and he has a term life policy for $2 million worth of coverage. Currently 42. At the time that his policy was written, it costing him $13,560 a year. Now, for some of us, that may not be a big problem, right? But I asked him a very real question, which was how things were going. He said, well, things are going okay, but this policy was written for when he was making a lot more money, right? So he was 38 when his initial policy was written. He's 42 now. Those of you who don't know, the older you are, the more expensive your insurance becomes, right? And for me and my partners, we don't look to talk to anyone about insurance over the age of 65. We talk to you about other things, right? But it doesn't mean that we can't help you. It just means that we have to help you in a unique fashion, one that caters to your suitability. All right. So we compared a $3 million policy for 35 years. It would cost him annually $999.92. In contrast to the $13,000 that he's spending annually on $3 million worth of cover, right? Now, our system also calculates what the additional savings required is. Now, just on the savings alone, right, and the cost of the premium, what we're looking at over the end of 35 years, $3 million, this individual would have $61,966, okay? Now, again, the coverage for insurance is separate from his, right? Now, over the course of 35 years, from just the investment portion alone, we're able to find him investment options that are at 3%, 6%, 9%, and even higher than that. For the sake of illustrations and, not wanting to overpromise and underdeliver, I would rather underpromise and overdeliver, right? Again, the cost of his policy, 35 years, is $461,000, right? But just from the investment alone, he generates $294,000. Now, what I'm going to do is I want to show you all something that I did for him. I calculated the cost of the difference of what he was paying into insurance, and I put that into his policy, right? Into this additional savings. Now, if it'll pull up, well, I still have some of the math. So if anyone wants to just quickly do the math, well, actually, it came out to $237 because we saved him in comparison, we saved him a couple of $1,000s, right? So we put the additional money, we divided that up into 12 months. It came out to about $237. Guys, please watch what happens when I press enter, especially paying attention to these numbers down here under 9 and 12%. At $237 a month, not only did we make his insurance free, right? This is how much he's going to spend at the end of 35 years. At 9%, walks away with $100,000 plus in profit. We just made his insurance free. Okay, that's our goal, to help people have more money available for them to use end of the term. And why am I saying term? Well, some people may not agree with term, but that's because they haven't seen a term policy like what we're doing. We're not focused on the insurance, we're focused on the investment. Because if you come back to me and you say, Prince, at 12%, I've made $1.5 million at the end of 35 years from an investment of $237 a month. I don't need insurance when I have $1.5 million. And you're right. You don't need insurance when you've got $1.5 million. That's our goal. Help you get to $1.5 million and also help you protect those assets the way that they should be. Okay, let me go back to the chat. Let me see, repeat on how to still access funds through trust while being married. Okay, I'm gonna touch on that real quick. All right. Repeat on how to still access funds through trust while being married. Okay, so you still have access to the funds in a trust as long as it's in a living revocable trust. Okay, you can still, it's a trust. You open up a bank account at the bank that you already have an account at. They're going to give you a whole other debit card, a new account specifically for the trust. And while you're married, so long as it's a joint living revocable trust, both members will have equal access to the account to make deposits and withdrawals. If you don't want that, then you may want to have a limited or a transfer on death or a single individual living revocable trust and then get a limited power of attorney to allow whoever you may want to benefit from the trust, like either they make deposits, but they don't make any withdrawals. That's another way for you to also authorize access to the account without, giving up in all of your control. All right. I hope that that made sense. Right. So I can see a great call. Got to jump onto another meeting. Looking for this recording. Thank you. For the person that's recording this, please email me after you've recorded. I am gonna upload it on. I'm gonna try to upload it onto the YouTube, and maybe the way that you've got it recorded may help me to blur out everyone else's faces. But if not, then I'm gonna have to get funky. So, but yeah, there are many ways to peel a plantain, as I like to say. We just got to find a way that works for you. Some of you guys might like boiled plantain. Some of you might like baked plantain. Some of you might like maduros. And some of you might be like, I don't even know what maduros is, but it sounds interesting, and maybe I do want that. But yeah, I don't want anyone thinking that they have to be on a lifetime diet of beans and rice to afford, good estate planning, income protection, being able to invest into your family and into yourselves at the end of the day. Finance, it should be about actually helping you grow money, not just having you spend money on things that, quite frankly, you know, like the client that I mentioned before, $3 million in total coverage. $2 million of that is costing him less than $900 a year. For the $1 million policy, he's paying over $10,000 for whole life coverage, for $1 million coverage. Why is it that the term life policy is so much cheaper? Right? Oh, that's because they're not offering you a savings vehicle. But I want a savings vehicle. Well, when on your car insurance, if you don't get into a car accident, do they give you money back? What about a house? If you don't get into it, no storm, no house damage, do they give you money back?
Not at all.
So that's the way pure protection is supposed to work. It's supposed to just protect your assets. It's not supposed to offer you anything else. If you have these things bundled, when you want to separate them, part of my whole life policy is being invested. Okay, well, why can't you separate the investment if you've reached a point where you no longer need the insurance? Why can't you cut it off? Oh, because it's bundled. So if I get rid of the insurance, I lose the investment. Come on now. Come on now. You mean you have to lose your protection when you just want the investment? You lose, and vice versa, you lose the investment if you cancel the coverage? There's something called a surrender charge. That's all the money that's saved up from those types of policies. And the hard conversation that most people don't want to have, but they end up having it too late, is that, well, you can't have that conversation from the pearly gates. That's number one. And the conversation I'm talking about is the one where you're like, how come my family's not getting the money that I put into savings? Oh, because that's not how your policy worked. It was in the fine print. We thought you would read it. People don't even read the information regarding the 12% interest rate that changes after 1 year, or 16, or 20%. But they still keep paying for it. Why is that? No one's bothering, no one's saying, we care about your best interest and about keeping you out of debt while you enjoy our financial product. But we also benefit from your irresponsibility. So pretend you didn't hear that last part and do as thou wilt. Whatever you want to do with it. 30% plus? Sure, go for it. What? It's not going to hurt your credit score. You can afford it. Of course, you got to pay it all back in order to avoid, that sudden drastic drop in your credit score. But hey, you'll be all right. No. Over 70% of the people who die in the US annually do so without an estate plan. The assets that they do acquire, because there's no, not even, because there might just be a will in place and a will can be challenged. Family shows up to court to get the letters of administration over and act as the executor over an estate. And the court says, no problem. You showed up first, you got it. Anyone challenge it? No. Done. That person's the executor. Oh, and by the way, executor, we're gonna charge you 45% on the taxes. All right. We got you covered though. No, you're the executor. You know, gun fingers, boom, boom. You're ready. Come on, come on. You know, they're gaming us. They don't want you to know this information because they benefit, they profit off 45% plus at the minimum, just to give letters of administration. So
Okay.
guys, if you know someone who is, you know, maybe has a will, tell them, make sure you update your will and then take that updated will and go get a trust. Okay. Tell them to do that. All right. And if they have any difficulties or they're looking for someone to do that, hey, you met this dark-skinned guy on this recording that someone else invited you to. He's got locks, and I trust the person that invited me to the call, but I should probably talk to him about whether or not, it actually help me out, right? So for those that maybe need to have that conversation, you don't know where to start, contact the person who invited you to this call today. Get in contact with us. We want to see you in the best position, right? Information is free. Conversation, it just costs you time. I'm not going to take up too much time. I only need to talk to you about 20 minutes. After that, if it don't make dollars and it don't make sense, you don't got it. There's no obligation to continue with anything, right? But if it's something that helps you, hey, we got some fast and cheap options, and then we got some fast but not cheap options. All right. We're going to provide you all the options available to you. All right. We've even got some specials for people who may need to speak to attorneys. All right. We got a referral service. Put you in contact with a team of attorneys. You could talk to them about, hey, if you got 5 different things you want to talk to them about in a day, you can call them 5 different times about 5 different issues. Your answers, no time limit, all of it's incorporated into your service, right? For those that definitely want to move forward with some asset protection, interested in getting a trust situated, contact us. We're here to do that. We do that at a flat rate, all right, cheaper than what most attorneys charge for it. Contact us. We'll share with you those details. Those who maybe want to do a comparison on the kind of insurance that they have with how we could help them grow their money to $1.5 million like we're doing for this other client, reach out to us. We're here to help you understand the system. We want, we don't have to be so in detail and overwhelm you with information. Just need the basics, all right? So at this point, guys, there are no other, I don't know if I've answered all the questions, but are there any other questions? No, no questions. Well, I guess that means I did a pretty bang up job. I'm hoping that that's the case. I'm seeing one person nodding their head, so that makes me feel good. We need one. Just need one. Oh, student loans. Excellent question. We got to go back to the student loan question real quick. Student loans are tricky, okay? And now these guys get people every year with student loans. Here's the thing. The student loan bracket, and I call it a racket because for each semester, there's a new loan that's created. So a student is going to have multiple student loans at the end of their college years that are all going to total one debt. However, because there's several multiple different loans, you have to pay each one individually. This is how they game us, okay? So what you can do is you can consolidate them to the youngest loan. You'll still have the same debt, okay? And you're gonna have to, oh, I don't pay anything on it right now, and oh, it's not growing, like it's not, no, there's still an interest that's on that. Okay, the principal amount doesn't grow. There's an interest that grows on it for every day and every year that goes by that you don't pay it, right? So I have nothing against the school, the educational system. I'm a graduate of it. All right, $150,000. This is how I know about this. All right, I've seen it on my own student loans. $150,000. There's a DR is in front of my name for a reason. All right. Didn't read. That's what it stands for. Didn't read. You read medical information. I didn't read the financial information. All right. $150,000. And every single penny of it was worth it. All right. They can't take the information from me.
Right.
All right. I'm unstoppable. Okay. But guys, they do it to us like that. The thing also about student loans is that if you ever tried to file bankruptcy, it's one of two debts that cannot be eliminated through bankruptcy filing. All right. So, and we don't live in a country where you get gainful employment after you graduate. We don't live in that country. Majority of people who get a degree end up in work that doesn't even come close to what they study. All right. I still figured out a way to make finance and health holistic. All right. And you're seeing it right here. And keeping people off drugs, lowering the cost of their medications. Anyone that's 65 or older, you got medications, and on the list of those medications, I'll find you a comparative quote and a better medical care. All right. Better health care covers some of the expenses that the government's not taking care of for you. All right. You need that, let me know. We got you. All right. But now what you can do is you find a new loan provider. Okay. We talked about credit cards. This is gonna be dangerous. About to be really dangerous. Okay. About to be really dangerous. So take what I say very cautiously. You can use your credit card to pay the student loan debt, right? That's one thing. You're able to use the entire student loans because $150,000 is a lot of money to me for student loans. I know people who've got $10,000 worth of student loan debt. They're like, Prince, this is outrageous. I'm like, what is? They're like, I got $10,000. That's a lot of money. I'm like, compare that to 150,000? You kidding me? But each of us is different. So we all see our these debts differently. So there's no judgment, right?
This
Not
is-
at all. But now, if you got $10,000 worth of credit, pay it off. You know what to do. Apply for a new credit card. You got 1 year. Get it down as quickly as possible. Pay it off with the next credit card. Might be a nice little system, all right? But it's a very risky one because doing that, you miss a payment. Anyone ever see what happens when the guy on the ski slope, the ski hits the snow when it like forks in? That guy goes tumbling, right? And it doesn't look like a very fun ride. I've seen people on skis like just tumble down ski slope. I never want to be that person. Snow is a lot harder than it looks too. It's a lot harder than it looks. Okay. But you miss one of those payments and it's a dangerous thing. Other options, go to a mortgage loan provider. Especially for those of you who are interested in purchasing a home in the future, look at the cost of the home, incorporate closing costs, and then incorporate the cost of the rest of your debt into that loan. And as long as the interest rate looks good to you, and there's no adjustments in the interest rate, what you can do is now you've got a new loan that you can apply for with the new interest rate, tackle that new payment, keep that minimum payment as low as paid off as fast as possible. That's a whole other thing, right? And hey, keep that history really good. By the time you finish paying it off, and even if you don't finish to pay it off, but you know, it's the reason why you might want to get homeowners insurance or a decreasing term life insurance policy, which will cover the cost of whatever remaining balance is due on the house while you're paying that down. That way, if and when you die before that term policy ends, right, your family, they'll be able to pay the mortgage and they'll be able to satisfy all the debts. And what did we just do? We just used insurance to take care of all the financial challenges and concerns. And now we've left the savings, the investment part of it, untouched. They'll pass on to the family along with whatever remaining life insurance proceeds may be left over. All right, guys, we're done. That's it for tonight. You want to know more? You got to come back next week. All right. I know some of my partners are already like, Prince, doing that thing again. One partner right now is looking at me like, man, we charge for that conversation, Prince. He's got a big old smile on his face right now too. He's not too happy with it. We charge for that.
As one of my mentors told me, if you don't have enough information to talk for the next 365 days, study some more. But I'd like to thank you, Doctor. I appreciate the energy, the spirit. And just this week, matter of fact, starting today, I challenge everybody on the phone right now, just do something different. How much different? Just 2%. Just take 2% and do something different, extra 2%. And while you do that, just as we're talking about credit, that compound interest is going to keep up because the next day you're going to do another 2%. So now you got 4% in. So it takes a 2% change in your mindset to create this. So as Prince has so eloquently has spoken, and we didn't even touch on the first half of it, this is just the wealth. And as he spoke about the brother who's on the deathbed, we're talking about the health too. So we want to make sure we align your health with your wealth, and our people need it. I just had 3 conversations today, and yeah, I just dropped some gems on a young son. I'm like, yo, I wish I was your age. You're 27 years old. All you have to do is drop $1.50 in an investment account. By the time you get my age, you got $2 million.
Yeah.
I just blew $100. I know. So that's our goal.
Yeah.
I thank you for your time, your energy, your spirit, your knowledge. And let's continue to build this team because this is what we're about, to enlighten our people and keep on pushing.
That's what we're doing. Making you wealthy, but also making you healthy enough to enjoy it while you're working for it, right? And while it's also working for you. So, ladies and gentlemen, for more information, feel free to reach out to the person who invited you tonight, and we will get it to you. All right. If you do have questions, you can message me at ELFLOWELLNESS@gmail.com. That's LFlow Wellness. Okay, FLO. No 2 W's, just 1 W.
Say it one more time.
LFlow, ELFlow, FLO, wellness@gmail.com. All right, I'm putting it into the group chat real quick, just so that way.
Yeah, I know it's in the recording there.
Yeah, just in case my accent gets in the way. Yeah, it's a little accent. It's not a big accent, but there it is. It's in the group chat. Please be sure to highlight, copy that, paste it. I could definitely talk about a new portion of information every day for the next 364 days. So,
Yeah.
I'm just trying to make sure I satisfy my business partner over there who's like, yo, Prince, save some for next week. And he's right. My other business partner is like, yo, we got to talk about that. We got to talk about that investment some more. So, and we do, because that investment, hey, some of you guys want to start college funds for your children. It could be $100 a month going into a 529. college savings account. All right. And what we can help you do for your kids, maybe they don't go to school, maybe they don't go to college. But as long as we could, as long as you might be okay with a little tax penalty, we can help you amass some money to help them start a business, to be industrious, to do more with their life instead of having to revert to job options that may give them a lot of cash real fast, but also put that ass
Mm,
tight position.
right.
let's let's keep the booties where they need to be covered. All right, we got to cover these assets. All right, guys. I'm done. I'm stopping. I'm done. I'm already. I've said too much. Have a great night, everyone.
All right. Blessings. Thank
Peace.